Good morning, everyone. I'll request Mr. John to initiate the webinar.
Hello, good morning, or good afternoon, depending on which part of the world you are watching this or participating from. Thank you for making the time to join Ghana Association of Bankers, working with Aptiva to bring to you our first webinar for 2021, Managing Banking Risks in Uncertain Times, the test case before us, which is COVID-19. The order of the program has been pasted in the text box. We will start with a welcome address by the president of our association, the Ghana Association of Bankers. That will be followed by a keynote address to be delivered by Dr. Ernest Addison, who is the governor of Bank of Ghana. Then we'll follow that with the presentation for the day, which will be facilitated by Aptiva. We'll have some questions and answers after the facilitation, after which the second deputy governor, Mrs. Siadu Awadzi, would give us the closing remarks. Then we end the program for the day. We've planned to spend a maximum of 1 hour and 45 minutes for this webinar. So to start off, I'll introduce our president, the president of Ghana Association of Bankers, Mrs. Mansa Neti, to give us the welcome address.
Thank you, John. And hello to everyone, and thank you for joining this webinar. Let me start by acknowledging the presence of the following individuals: the governor of the Central Bank, Dr. Addison, the second deputy governor, LC Awadzi, and my hello to my fellow CEOs and bankers, and to the presenters and moderators, and ladies and gentlemen. I would like to thank, first of all, the leadership of the Central Bank for their eagerness and willingness to lead the discussion on this rather important and pressing topic facing the industry today. I think Ghana's banking sector, has undergone, marked transformation over the last decade. And this is due to the comprehensive reforms that was recently undertaken by the Central Bank to strengthen and deepen the character of the sector. These reforms, which led to the issuance of a new minimum capital directive, has contributed to the robustness and resilience of the industry and speaks volumes about the sector's ability to withstand, the shocks caused by the pandemic. The pandemic has undoubtedly affected our industry, our clients, and overall, business operations across. The move from a world of consistent physical contact in our operations to a virtual environment has become drastic and a reflection of the new direction and the need for an acute mindset change if we are to survive and stay relevant. Mindful of the role that banks play in stimulating the growth of our economy, a review of the risk framework and processes remains critical to providing the right levels of support that will complement the changes in the consumer behavior and needs that we are currently experiencing. With this backdrop, we all have a responsibility to review our financial models while adapting to the new digital habits faster than ever imagined. If we are to return to the normal levels in the immediate future. The pandemic has undoubtedly forced every bank to take a critical look at their business model and fashion out appropriate ways to survive and grow our businesses. To further strengthen our balance sheets and have the ability to absorb losses, we as banks need to maintain a robust risk management framework that will further, withstand shocks associated to the ongoing pandemic, especially as we're experiencing, the second wave. The topic chosen for the webinar is timely and poignant as we critically assess our individual situations and redefine our strategies for the future. Today, we are confronted with several risks, including people, cybersecurity, operational, strategic, and balance sheets, all of which require careful attention. We need to dissect these into greater detail and establish certain controls that tighten our business model. The Association of Bankers has a greater responsibility to continue ensuring that member banks feel empowered and well-resourced to continue on this journey of extending the right level of credits and recovery effectively without impacting the stability of our economy. The banking industry has previously navigated similar crises. A typical example was our concerted efforts under the leadership of the former president, Alassane Andani, to engage in an impassioned advocacy to recover credit losses at a time that the sector was facing an NPL crisis. In all these, the central bank has proven to be a bona fide regulator and always ready to lend a helping hand. I believe we shall exit this meeting with the right information and direction to start thinking seriously, about these. Having taken over as president of GAB, of Ghana Association of Bankers, just a little over a month, I already feel empowered and supported by the diversity of stakeholders we have to continue playing a relevant role in Ghana's socioeconomic growth story. The association will require the implementation of a strong advocacy drive centered on a robust risk management framework, digitization agenda, and an integral purpose-led sustainability drive that will help create formidable partnerships with other relevant sectors in order to command industry leadership. I will end here and once again thank all of you for joining the webinar and look forward to an insightful and progressive session. Thank you very much. John, I'll hand over back to you.
John, you're on mute.
John, I think you're on mute.
Yeah, thank you very much, Mansa, President of Ghana Association of Bankers. We appreciate your time and for being with us. So we move on to the next item on the agenda, which is to invite the Governor of Bank of Ghana, Dr. Ernest Addison. Dr. Addison is a Ghanaian economist who is currently the 7th Governor of Bank of Ghana and the 15th Governor of the Central Bank. He had previously worked at the same central bank as the Director of Research from 2003 to 2011 and as an economist at the African Development Bank. Dr. Addison was recently awarded the Best Central Bank Governor in Sub-Saharan Africa in 2020. Ladies and gentlemen, please join me to welcome Dr. Ernest Addison to give us the keynote address.
Okay, thank you very much, Mr. John Iwa, the President of the Ghana Association of Bankers, Chief Executive Officer of the Association of Bankers, members of the Executive Council of the Association, distinguished resource persons, invited guests, ladies and gentlemen, good morning. It is always an honor to interact with stakeholders in the financial sector, especially the banking fraternity. Exactly a year ago, the global economy was hit with a pandemic, the scale of which has not been witnessed since the Spanish flu of 1918. As we meet today, there appears to be no relapse, and we are seeing higher infection rates compounded by the emergence of new variants. Although this began as a health crisis, it quickly turned into an economic and financial crisis as measures taken to halt the spread of the virus created a sudden stop in economic activity, dampening economic growth and posing significant risks to financial systems, which required timely policy interventions. It is in this regard that I applaud the Ghana Association of Bankers, Executive Council, and the organizers of this webinar for this important discourse under the theme, Managing Banking Risks in Uncertain Times, the COVID-19 test case. This is timely as it presents a unique opportunity for us to deliberate on the risk emerging in the financial sector as a result of the COVID-19 pandemic and explore the policy options and measures needed to manage such risks in these uncertain times. Ladies and gentlemen, the human health, economic, and financial costs of this pandemic are still mounting. In Ghana, we were fortunate that the financial sector reforms introduced over the last 3 years strengthened the balance sheet of banks and improved their solvency. The banking system was better placed to absorb crisis and provide the financing needs of the economy as a result of the reforms, including the recapitalization of banks. Secondly, the government was swift in putting into place measures to mitigate the impact of the crisis on the economy. The bold measures, including the COVID-19 alleviation program to contain the economic burden of the pandemic on households and small businesses, including the 600 million financial support to medium and small scale enterprises, the absorption of water and electricity bills, tax relief for frontline workers, among others. In the financial sector, the Bank of Ghana introduced policies and regulatory reliefs to support credit extension and ease off possible sector liquidity constraints that may emerge as a result of the pandemic. Among others, the bank lowered the policy rate by 150 basis points and reduced the macro-prudential capital conservation buffer and cash reserve requirements for banks, as well as lowered the primary reserve ratio of savings and loan companies, finance houses, and rural and community banks. The provisioning for loans in the OLM category was also lowered for both banks and the specialized deposit-taking institutions. To a large extent, these regulatory reliefs provided timely for the banking sector as it navigated an uncharted path during the pandemic. The latest assessments have shown the resilience of banks to the first wave of the pandemic, supported by strong policy support and the regulatory reliefs. New advances grew by 15.8% year-on-year to 34.4 billion in 2020, and banks provided support and reliefs in the form of loan restructuring and loan repayment moratoria to cushion some 16,694 customers severely impacted by the pandemic. At the end of December 2020, total outstanding loans restructured by banks amounted to 4.5 billion, representing about 9.4% of the industry's loan portfolio. These add to the strong outturn of the financial soundness indicators, alongside strong growth in assets, deposits, and investments. These positive results notwithstanding, we must admit that the pandemic has introduced several risks in the sector. Let me highlight 3 major risks that the pandemic either unearthed or intensified, which must be efficiently managed by banks to avoid any unintended consequences of the industry. These are cybersecurity risks, credit risks, and operational risks. Although the pandemic boosted the move towards digital transactions and financial inclusion, it also brought in its wake a heightened sense of cyber attacks within the sector. The use of digital and mobile banking platforms to conduct banking transactions has increased since the outbreak of the pandemic. This is evident by peer-to-peer, bank-to-wallet, wallet-to-bank, wallet-to-bank transactions across all platforms. Banks have responded positively to this phenomenon and deployed sophisticated yet user-friendly digital platforms to enhance the delivery of financial services. This trend is indeed welcome as it broadly aligns with the overall objective of digitizing the Ghanaian economy and promoting financial inclusion and growth. Yet the drive towards more digitization has heightened cyber risk and fraud, and therefore calls for effective cyber risk management policies and procedures by banks. The Bank of Ghana expects all banks to build robust systems to forestall such cybersecurity incidents. All the successes showed in the digitization of banking systems will be eroded if inadequate investments are not made for effective protection of the information technology and security infrastructure. In this regard, the bank has issued directives and guidelines, such as the Cybersecurity Directive, that banks must meet on an ongoing basis to effectively manage cyber risk and fraud. Secondly, credit risk has become critical and requires the attention of all of us. The sharp slowdown in economic activity has ramifications for the solvency of some households and businesses. Lenders within sectors strongly hit by the impact of the pandemic, particularly those in industry and services, are more vulnerable. To possibly mitigate the risk, moratoria on repayment of loans and overdraft facilities, flexibility in the application of accounting and regulatory standards in the treatment of potentially impaired loans have been emphasized by international accounting standard sectors and the bank. This is why the introduction of regulatory reliefs has improved timely, and banks have responded appropriately with some form of forbearance for customers. These include rolling forward interest rates, interest and principal payments, interest repayment waivers, and offering new loans to enable borrowers with reasonable longer-term prospects stay afloat in these challenging times. The challenge going forward is how well banks account for the impact of the reliefs in terms of loan classification, expected credit losses, provisioning, credit risk weightings, and the overall impact on their capital ratios and key performance indicators. For instance, loan loss provisions grew by 28%, higher than the 23.8% recorded a year ago, and reflecting elevated credit risks in 2020. Higher provisioning helps to improve loss absorption capacity, and the early recognition of losses is helpful. Non-performing loans ratio of the industry increased from 14.3% in December 2019 to 15.7% in June 2020, arising from the pandemic-induced repayment challenges, but has since declined to 14.8% in December 2020 due to loan write-offs and increased credits, particularly in the last quarter. In response to these developments, banks may need to strengthen credit risk management policies and engage in risk-sharing arrangements through syndications. The COVID-19 related partial lockdowns and restrictions instigated the work from home concept, which poses some operational risks to the industry if not well managed and can affect the smooth operations of any bank. The engagement of third parties by some banks to perform some non-core functions would also be threatened by weaknesses in financial and operational resilience. The industry data showed that growth in operating expenses moderated from 11.1% in 2019 to 8.2% in 2020, driven mainly by a slowdown in growth of staff-related costs, which recorded a 6.2% growth in 2020 compared with 14.7% a year ago. Other operating expenses, however, increased by 10.6% from 7.2% a year earlier. Part of the increase in other operating expenses was related to costs associated with implementing safety protocols and containment measures of the COVID-19, as well as activation of business continuity plans by banks. Notwithstanding the pandemic-induced increases in the industry's cost of operations, banks did not pass on these costs to consumers in the form of higher interest margins, but adopted other cost control measures to cushion their bottom line. Disruptions in banks' operations and business continuity concerns orchestrated by the pandemic remains critical in these uncertain times, especially with the recent second wave. We must all adapt to this new normal of working, and going forward, BCPs must focus on endpoint and network security measures with robust user authentication protocols to minimize abuse of bank systems. Risk-based business continuity plans and innovation stands out as the key to survive in uncertain times. Consequently, operational risks need to be effectively managed, and banks must continuously test the adequacy of their BCPs to facilitate continuous operations and service delivery. As regulators, ladies and gentlemen, let me assure you that the Bank of Ghana is continuously monitoring the financial and economic environment to ensure the banking system operates effectively in delivering financial intermediation to support the recovery efforts. To this end, the policy measures, including the reduction in regulatory buffers, are designed to help banks to continue providing financing to households and businesses. To further build our defenses against the pandemic, I would encourage the Ghana Association of Banks to continuously engage industry players to collectively strengthen their operational resilience in these times. From the supervisory perspective, I would entreat the various risk managers to continuously stress test your banks under different extreme but plausible scenarios to enable you contain possible risks that may emanate from the COVID-induced uncertainties. Let me conclude by encouraging industry players to strictly observe the COVID-19 protocols, and with the Ghana Association of Banks as a common front, let us explore innovative ways to conduct the banking business in a safe and convenient environment. I am sure that this webinar will offer insights on how we can innovate and stay competitive as we navigate through the risks imposed by these uncertain times of the pandemic. I wish you all fruitful deliberations, and I thank you for your attention. Thank you.
Thank you. Thank you very much, Governor Dr. Addison, for a well-delivered keynote address emphasizing all the regulatory measures that Bank of Ghana has undertaken to lessen the burden of the pandemic on banks in particular and the banking population at large. Your delivery sets the tone, actually the right tone, for the subject matter for today's webinar. Once again, on behalf of the Ghana Association of Bankers, we say a big thank you to you. I would like at this point to recognize the presence of a few dignitaries we have on the webinar. We have Mr. Dansaki, who is the Vice President of the Ghana Association of Bankers. He's on the call. Mr. Farid Anta, the MD of Republic Bank. Mr. Kojo Mata, MD, ARB Apex Bank. Mr. Kwamina Asumenin, MD of Stanbic Bank. Mr. Olalikan Balogun, MD of UBA. We have Mr. Osei Jesse, the Head of Banking Supervision of Bank of Ghana. Mr. Philip Oredu, MD of Carl Bank and a member of the Executive Council of the Ghana Association of Bankers. We also have Mrs. Abna Osei-Poku, MD of Absa Bank and also a member of the Executive Council of the Association. At this point, we'll move on to the next item on the agenda, which is move to the key reason why we are here, which is the delivery on the managing banking risk in uncertain times. To help us to deliver on the subject matter, we have Mr. Alok Tiwari, who is the co-founder of Aptiva. He is a well-regarded expert in risk management area with a successful track record of building and scaling highly disruptive global ventures in the financial services industry with a strong focus on risk management, artificial intelligence, and analytics. He's a co-founder of Aptiva. We also have Ashley Chirian. He's a director. Ashley has several years of experience in the banking sector across the areas of credit, market, and operational risk. He has managed multidisciplinary objects, including consideration of data, analytical modeling, governance, methodology tools, and process issues. He has significant exposure in model development and validation in various jurisdictions. At Aptiva, Ashley has immensely contributed in developing strategic and tactical tools for modeling risk management. And finally, we have Satya Verimedi, who is a director at Aptiva. Satya brings a long experience in balance sheet management, risk advisory, and developing advanced analytical frameworks that help banks better manage their balance sheets, and which is a key reason why we've gathered this morning. At this point, I'll hand over to Aptiva to help us at the next session. Thank you.
So thank you, John. First of all, I like to thank Dr. Ernest Edison and Honorable Governor Bank of Ghana and Second Deputy Governor Elsie Wazi for gracing this occasion. Thank you also to Mansa Netty and John and Ghana Banking Association of Bankers for inviting us and participate and share our thoughts on what's happening globally in the area of risks and how banks are reacting to it. And what we plan to do today, share what we are seeing in different geographies and how banks, regulators, and have reacted to the crisis and how it has changed risk and risk management. So that is the agenda from our side. So the only thing which is certain in uncertainty is the uncertainty. So if we just go back, 11 months, March 2020, as Dr. Edison mentioned, we were dealing with a completely unknown crisis. Any living human has not dealt with the nature, duration, intensity, and impact of such crisis. So it was a complete, from a risk point of view, a situation where we were dealing with unknown unknowns. Fast forward today, a lot of things are known and there are a lot of known unknowns. So what we know today, we certainly know the nature of the crisis well. We understand what are the different dimensions of the crisis and how to deal with it. So that is fairly well known. It's still not completely known, but and we have made good progress globally with so far 5 approved vaccines, close to 150 million plus people being vaccinated. So that gives us some control over the nature of this crisis. The duration still remains partly unknown because it has taken a very regional or local variation. So the problem has got local variations, and the local variations are adding to the complexity of estimating the duration when we will come out of this crisis. So that is varying from region to region. Hopefully, next few weeks or few months, we get a better control over these local variations and get a better fix on the duration and when we all can come out of it. The intensity is largely known today and fairly well estimated in terms of what it can do and who it can impact, and that ranges from financial markets to industry to social. So that is a known parameter today. And impact is, I would say, somewhat largely known. Some part is still unknown. So we today know IMF has forecasted that 2021 the global growth will be 5.5%, which is up of 3.3 percentage point. We have estimate globally banks are going to provide about 1.8 trillion in credit loss provisions, which is down 15% from earlier estimate of 2.1 trillion, which is again a good news. So now we are at least in much better situation from a risk point of view, where at least we know about what is not known. So that is where we are, today. Now, how it has changed the outlook about risk, and especially how regulators and banks have looked at risk. So pre-COVID world, if we just go back 11 months and see the risk management, the basic thought process was it was incremental view on business. So banks used to look incrementally for next 12 months, 24 months, business as usual. And a lot of focus was around the pillar one of the risk management, which dealt largely with the adequacy of capital and provisions to deal with the forecasted scenario. So I would call it a somewhat, static or less dynamic way of looking at the business. What has changed dramatically is that all of us have seen an event which nobody ever have anticipated and known, and the severity and the duration of this event has significantly tested the resilience of banks, financial markets, and uh, different parts of the businesses. So there is a big change. Risk management has now been looked in conjunction with resilience. So resilience becoming a central theme. And what that mean is that you got to take a dynamic view of the future. A dynamic view essentially means you got to forecast scenarios, and these scenarios could be favorable to adverse to severely adverse scenarios for your businesses. It may deal with the macro environment in which you are operating. It may deal with some idiosyncratic factors which are very specific to your bank or your businesses, and it will deal with the nature and likelihood and impact of risks. So that makes it uh, a regime which significantly brings what classically called the pillar two dimension of risks, which are the risks over and above the pillar one risks, which we are familiar with. And in many jurisdiction, somewhere it is called stress testing, somewhere it is called capital planning. But that is increasingly seems to be the direction in which banks are moving. Now, if I go further, to the next slide, please. So if I have to break down the resilience, they're largely three component, and that's what the regulators and the board and the management today focuses. So the first aspect deals with the business resilience, which is basically your ability to survive and thrive. So this is very important, that it's not only the survival, but how do you bounce back? And the bouncing back is equally important for you to successfully in dealing with the crisis and the post-crisis scenario. And obviously, on the business front, what is driving the change is digitization, the innovation, and your agility to respond with rapidly changing customer behavior and needs. Now, a lot of that has got significantly accelerated due to this pandemic, and Mansa pointed that out. So a lot of things which we never thought are possible, things like remote working and serving customers on digitalization or the adoption of digitization by customer, that all got accelerated, and that is fundamentally changing the way you do the business and react to this situation. So that's the business resilience aspect. Then we come to the financial resilience, which is the financial ability to maintain sufficient capital liquidity levels so that you can continue to operate through the times of severe economic and financial stress. So that means you've got to have a robust forward-looking capital planning process, which accounts for every single possible risk. And then the third pillar, which largely deals with operational resilience. So again, it is an addition to the conventional operational risk. So this is operational risk plus plus today. And as Dr. Addison pointed out, some aspect of operational risk has grown quite significantly in terms of the cyber frauds and business continuity issues which banks have gone through. And keeping that in mind, globally, the regulator across the globe, starting with the Basel Committee, has issued the specific guidance on the principle of operational resilience. And earlier last year, the regulator here in the UK, Prudential Regulatory Authority, was the first one globally to issue a guidance on operational resilience, and it is likely to be followed by Federal Reserves and regulators across the world. For the purpose of today's discussion, we will focus specifically on the middle financial resilience part, and obviously we would continue to do follow-up webinars where we can cover the other two aspects as well in different, but what we're going to focus today on financial resilience, and within that we're going to focus specifically on two most critical dimensions. One is the ability to manage the balance sheet from liquidity, funding, profitability, and interest rate risk point of view. And as Dr. Addison highlighted, also equally important to deal with the credit risk aspects. So the financial resilience is going to be the focus of our discussion today. And what we like to cover, that how banks can build an integrated balance sheet management framework, which is forward looking. It's important to remember it's a forward looking framework, a dynamic framework, where you can monitor and measure and manage all the key matrices, whether it links to your capital level or estimation of your credit losses, funding situation, the liquidity situation, your profit margins or interest rate risk, or the other aspects of market and operational risk. So with that, I'll hand it over to my colleague Satya, who will take us through the first part, talk about what we are seeing globally in the area of balance sheet management.
Yeah, thanks, Alok. So as Alok mentioned earlier, so this pandemic has impacted banks, across several risk categories. So, this slide tries to capture, how the pandemic has impacted the banking sector. Starting, with the pillar one risks, including, the credit risk, where, you focus on your NPL levels, risk-weighted assets, the expected credit losses, and the coverage of from a provisioning perspective. So during the pandemic, even though at an initial stage, primarily it was revolving around liquidity, but soon, banks realized that liquidity is not a primary issue, largely because because of the stoppage of economic activity, a lot of idle funds have returned back to the banking system. But on the other case, because of drop in economic activity, there's been a gradual impact on the credit quality of the loan portfolios. So banks have witnessed increase in default levels. There's been higher level of counterparty and sovereign default risk, and there's increase in probability of default and expected credit losses projected by models. So a number of models that were used or built prior to the pandemic that were using macroeconomic factors like GDP growth, inflation, interest rate levels, commodity prices, for example, oil prices, to project PDs and thereby computing ECLs have started giving out a larger impact on the from a provisioning perspective. So as Alok mentioned, that assessment ran into trillions of dollars. But as the situation becomes more clear, banks are able to reassess the impact on account of these changes. And of course, I mean, there's been a lot of focus on business continuity and a lot of disruptions, because of the sudden lockdowns that were imposed across the globe. On the liquidity side, even though initially, as I mentioned, there was a lot of inflow back into the system, but gradually a lot of organizations and individuals who have started seeing lower levels of revenues and cash flows have started withdrawing. So there was a gradual withdrawal of deposits and runoffs on the deposit portfolios, even though still, from a liquidity perspective, banks are still holding a good level of HQLA buffers, and the deposit levels have been, better. But on the flip side, that has created pressure on treasuries and ALM desks to find alternative, opportunities that return higher margins where these idle funds can then be deployed. Some aspects of regulatory intervention in terms of reduction in the reserve requirements, for example, or reduction in the thresholds of these liquidity ratios have also helped banks. But still, as the pandemic evolves, we expect to see liquidity to be a key challenge as the cash flows start picking up as the economies pick up. So banks will face certain challenges in liquidity positions as the funding spreads widen and the funding renewals drop due to increase in operations. And on the market risk side, of course, there have been a lot of volatility in international securities markets. And primarily, from a regional perspective, there's been a lot of pressure on the local currencies due to scarcity in dollar conversions and any other G8 currency conversions. And this has impacted banks in terms of their exposures to any unhedged structural FX positions. And further, as the situation evolves, the changing investor risk appetite may further impact the valuations of stock markets. This may also have certain impact in terms of securities or instruments that were earlier considered liquid in nature, other than what was usually part of your HQLA. The ability of the banks to repo certain securities to raise funding, that may also be challenged because of the experienced volatility. And from an operational risk perspective, there has been, again, a number of disruptions. Primarily, I mean, this has been a very big area of impact, in terms of how to rebuild the SLAs, how to readjust to remote work, and how operational costs, can be reduced, while at the same time supporting work from home and newer, forms of logistics to support remote work. And of course, as Alok mentioned, and earlier, as Mr. Dr. Edison mentioned, increase in cyber fraud and malware incidents, and a number of security breaches reported, a higher level of losses on the operational risk side. And coming to the pillar 2 side, which include the interest rate risk on the banking book, funding risk, and the internal liquidity adequacy assessments, and the associated stress testings on the ICAP and ILAP, and as well as on the credit side, you have the credit concentration risk. So on these aspects, from an IRBB perspective, interest rate risk perspective, there's been a shift to a downward interest rate environment globally. I mean, we have seen historically low levels of interest rates prevailing across global currencies, and a lot of currencies, including the euro, Japanese yen, have gone into the negative territory, where there's a cost of placing deposits with banks rather than generating returns. And on the flip side, banks also started facing impact in terms of their NIIs getting impacted because of low pricing environment. I mean, any banks that could take immediate action in terms of reducing their deposit prices or readjusting the deposit prices will be able to sustain their net interest margins. So new hedging strategies and new pricing strategies will be required to reorient, from an interest rate risk perspective. And similarly, from a funding risk, as I've just mentioned, there'll be, as operations restart, there'll be, higher levels of runoffs experienced on wholesale and retail funding sources, and other pillar 2 aspects of funding and liquidity, including intraday liquidity risk, and from a risk management perspective, the adequacy of the risk appetite, both in BAU and stress situations. So that it captures, in terms of how COVID has impacted banks across various risk categories. So that brings us to, from a senior management perspective. So this, once the economy starts looking up, what is the view, or what is the approach that management needs to adopt in revisiting their balance sheet strategy? Of course, it's given under the primary challenge is that banks now need to support the economic recovery planned by their respective jurisdictions, while at the same time keeping an eye on the health of portfolios that have been impacted due to the pandemic. So that is, a dual-edged, challenge, where any uncontrolled growth to support economic recovery might lead to long-term, NPLs and increase in provision levels, impacting the bottom line. At the same time, not playing your role in, in the recovery might leave you behind in terms of your position in the market, as the economy recovers. So it's a tight balancing line that banks will now need to play. So what that means is they really need to evaluate or reevaluate their key strategic objectives under various prevailing conditions, like increased riskiness on the balance sheet. So this is an important aspect that we just talked about. Regulatory tightening, for example, so far during the pandemic, regulators have played a very supportive role in helping banks, ensuring that sufficient funding is available to critical sectors, waiving of certain, thresholds in terms of reporting and maintaining, capital and liquidity buffers. But as the pandemic eases, we expect central banks to start looking at more closely, because there'll be a lot of pressure on central banks to ensure that the economic recovery is maintained, while banks' health is also maintained at the same time. So that means close monitoring and ensuring that there is a clear picture of exactly what's happening in the banking sector. And the third aspect that needs to be, considered when revisiting the strategy is the witnessed fundamental shift in the customer behavior. So from a customer's perspective, a number of behavioral aspects like their repayment, behaviors, their loan prepayment behaviors, in terms of deposits, the long-term average runoffs witnessed on demand deposits or rollovers expected in term deposit portfolios, drawdown on committed lines, or drawdown on other revolving credit lines. So a number of these behaviors seem to have shifted fundamentally, given that there is a lot of uncertainty in the market currently, and therefore there will be increased need for customers to curtail their spending and behave in a prudential way. So given those, let's see how these considerations can be considered while revisiting the strategy. When you talk about strategy, we look at it from 4 key pillars in terms of the direction that banks need to take during the next 12 or 12 months in the short term, or medium term, 3 to 5 years. The growth levels expected. So what are the realistic expectations in terms of the targets that they can achieve? And the efficiency in terms of operational efficiency, how can they ensure that costs are kept to a minimum, while at the same time, improve their service levels towards customers. And of course, the most important aspect is the health, how banks can ensure there is robust governance on their risk portfolios, while maintaining board level oversight and controls on new position originations, and how they can ensure that their risk appetite targets are met in terms of their credit ratings, in terms of the levels of liquidity held, in terms of capital adequacy, so on and so forth. So in these areas, so when we talk about direction, we are primarily looking at the positioning of the bank, whether they want to position themselves as a digital bank, as a universal bank, or a wholesale bank, retail bank. So obviously there needs to be a rethink, and probably a number of within universal banks, again, in terms of the segmentations, the sectors that they focus on, the type of products offered, the tenors and the pricing structures of products. So all these aspects need to be relooked at. From some considerations in relooking these is, what are the sectors that have been impacted due to the COVID pandemic, and what is the level of recovery expected in each of these key sectors? This is a primary understanding required to set the direction. And then in terms of the product structures, probably now is the time to re-evaluate the maturity profiles on the balance sheet, looking at how banks can curtail long-term asset generation, while at the same time ensuring that all the customer requirements are met. Because there is a lot of uncertainty, it is important that banks preserve their HQLA and capital levels at least until the situation becomes more clear. So it is important to restructure products focusing on more shorter term and less riskier portfolios. But of course, I mean, that also means that there needs to be closer monitoring, or the frameworks required to assess the riskiness in these portfolios need to be enhanced. And in terms of growth, there needs to be a realistic expectation given the projections, the revised projections for macro indicators. Historically, whatever might have been the assumptions, in terms of BAU assumptions of growth that are possible during the year, those assumptions will need to be reassessed. So this can be done by looking at historical crisis that may have happened, either the global financial crisis or the oil price shock that was witnessed in 2016, or any other regional shocks that may have happened during any point in time during the last 5 to 10 years, and reassess the linkages between macro factors and the growth witnessed during that period. So that sets a realistic expectation in terms of the growth that is possible within the banking sector and within each specific bank. And the efficiency aspect is something which many speakers have already mentioned, in terms of the primary concern being a shift to from a physical approach of banking to a digital approach of banking. So this is something probably we can leave for a different talk. Then coming to health, how banks can recalibrate their risk appetite, originating from all the impacts from the risks that we have just seen, and also how can they consider the impact of macro environment while recalibrating their risk appetite. Now, to perform all these analytics, banks need to look at their analytical frameworks. They need to be able to perform integrated risk analysis, taking into account their changes in business plans, their expectations of growth, and what kind of risk appetite that they want to maintain. So it is very important to so this brings from a balance sheet perspective, asset liability committee is the primary management committee that looks at from a business planning and risk management perspective, from a liquidity, interest rate risk, funding, and capital management perspective. Usually, ALCO comprises of finance, risk, and treasury senior management, and usually chaired by the CEO or the CFO, both of which are observed in the market. And ALCO has the remit, to look at various aspects of asset liability management, balance sheet composition, and various aspects of planning, execution, and monitoring of performance of the balance sheet. So some of the key challenges in front of ALCO, from a risk perspective, is how can the bank ensure that all material risks on the balance sheet are measured and monitored accurately, given the linkages between a number of these risks have changed, and also the severity observed in these risks have also changed. So maybe certain risks may have not been material historically, but because of the pandemic, certain risks have now become material. Or maybe there's a certain level of correlation between certain risks. For example, what is the interplay between liquidity and credit, and what is the interplay between, for example, interest rate risk and credit risk. How those linkages can be rebuilt or reassessed. How the overall risk management framework can be integrated to be able to assess all the risks on the balance sheet using a single analytical model. Then from a strategic planning perspective, the key concern would be, how do I protect the bank's net interest margin and ensure that the planned growth is realistic and within the risk appetite. So this will require, as the finance department or the strategic planning department develops their plans for the coming year, they need to keep in mind that, as Alok mentioned earlier, that the only thing that is currently certain is the uncertainty. So that means they need to be able to quickly model a number of scenarios, from a macroeconomic perspective, and as well as multiple business plans in terms of various levels of growth across sectors, across products, and multiple product structures. So this capability is very critical, given the level of uncertainty. So when the situation is certain and expected to be just like how it was last year, there you can take a leeway of assuming certain standard things, in the growth level of various products and sectors, and then probably generate 1, 2, or 3 possible scenarios, upward, upside, a base case, and an adverse scenario. But given the level of uncertainty being witnessed right now, it is important that the simulation frameworks be advanced enough and fast enough to perform multiple simulations quickly. And from a funding and capital management perspective, which is usually the remit of Treasury and the ALM desk, optimizing the level of liquidity, ensuring that the liquidity level held is adequate to meet any of the obligations, either considering a business as usual scenario or a moderate to severe to very severe types of stress events that may occur anytime during the planned period. And in terms of the funding profile, is there a necessity to issue new capital instruments, given that there will be subdued growth in internal capital origination on account of reduced profitability? And finally, is the bank operationally ready to invoke their contingency funding plans? Is the funding plan realistic, that all the assumptions that are made in terms of the funding that they can draw in times of stress from various sources, are their systems operationally ready to raise such deposits? Will they be able to make quick decisions and implement them down the chain of command in terms of changing the pricing spreads on the deposit side as well as on the loan side to curtail loan growth? So these are some very fundamental questions in front of ALCO. And how banks can address some of these challenges. So a few aspects I would like to highlight here. The most fundamental aspect is, yes, right. I mean, banks need to be able to support the economic growth, but more importantly, they should not lose sight of their ability to continue their franchise viability. What that means is they should ensure that they still have the ability to keep issuing loans, keep raising deposits, and roll over their business on a business as usual basis. Even during stress, probably the level of activities may go down, but it is very important that a large part of their investment book be kept as HQLA to ensure that their daily operations continue. And the second aspect is recalibrating the stress testing scenarios. Again, as we mentioned, the level of runoffs that you may expect in your deposit side, the level of prepayments that you may expect during the next 12 months, or the level of haircuts that you may see on liquid portfolios, the level of drawdowns and devolvements on committed undrawn facilities and letters of credit, for example. So these risks need to be modeled accurately as part of the Pillar 2 stress testing framework, which is in this case, from a liquidity perspective, is the internal liquidity adequacy assessment plan. And then once these objectives are achieved, that means they have the basic level of capital and liquidity to sustain the business. They clearly understand the impact on their business because of any unforeseen or adverse or very severe stress cases. And then the third aspect is then to closely coordinate between business origination and risk function. Historically, only during the initial planning phase is where risk is involved to ensure that the business plans that have been developed are in line with the risk appetite. But given the nature of uncertainty prevailing, it is very essential that business origination functions and risk functions talk to each other very closely to ensure that all the new originations that are happening are strictly monitored by risk, and they are modeled to ensure the kind of impact that they can expect, and even after severe stress, that the impact should be within the expected thresholds or manageable thresholds. So this aspect is crucial going forward as banks look to support economic growth but at the same time maintain the health aspect of the strategy. To support this, there needs to be increased granularity and frequency of reporting that happens at ALCO and credit committees. And ALCOs need to disseminate regular information on balance sheet to key stakeholders, and regular information on funding profiles, on available stable funding, lines of funding available during stress, and ensure that key personnel that are required to manage liquidity and funding are available, or at least their backups are available on a regular basis. This essentially means that their contingency funding plans need to be tested on a much more frequent basis. Historically, contingency funding plans used to be just be on paper. Slowly, after the financial crisis, regulators have started pushing banks to operationalize their contingency funding plans and ensure that regular testing of the plan is done, both dry testing and wet testing. Dry testing in terms of ability of the bank to produce the stressed impact, availability of the personnel to drive the response, and the communication strategy to ensure that the right kind of communication goes out to the regulator, to the stakeholders, and to the general public. But after this crisis, it may become necessary that every quarter or even every month that Treasury needs to Treasury and various stakeholders within ALCO need to ensure that some aspect of the contingency funding plan is tested on a regular basis. And that brings us, in terms of the analytical capabilities that banks need to look at to generate frequent and dynamic projections of their balance sheet as the scenarios keep changing as the situation evolves. So this may include building or enhancing a single source of data, integrated balance sheet models with cross linkages across risk categories. This may require historical quantitative analysis to link up changes in cash flows with either macro parameters or internal risk parameters, like, for example, how delinquencies, monitoring delinquencies historically, monitoring prepayments historically, monitoring drawdowns on portfolios historically, so on and so forth. And quantification of these risk factors can then be used to apply in the integrated balance sheet model to do a number of what-if analytics. So these aspects, when taken together, might help banks chart a path out of the pandemic, while at the same time supporting the planned economic growth of within their respective jurisdictions. A small illustration in terms of an ideal integrated balance sheet model that we have built that incorporates aspects of the capital in terms of the capital adequacy computation, the ILAP in terms of liquidity stress assessment, adequacy of liquidity as per the business plan, and various other pillar 2 risks within liquidity in terms of retail funding risk, wholesale funding risk, off-balance sheet risk, marketable securities risk, non-marketable assets risk, deposit pricing risk, and bringing in the funding strategy as well in terms of what kind of funding is expected over the next time horizon, and how those aspects have been integrated into a single balance sheet model to assess impact on key liquidity metrics, and how within the same framework we can insert management actions. For example, from a liquidity perspective, how raising repo funding can help meet immediate liquidity outflows, how what level of deposits can banks raise during stress from money markets or from their strategic investors, what kind of deposit spreads will they expect to pay, and how it will translate into the impact on their profitability, and what kind of actions can they take in terms of restricting loan rollovers and repayments, and also in terms of delayed disbursements and freezing uncommitted lines. So how these actions can restore your level of liquidity, within the same integrated model has been demonstrated. And using the tool, we have been able to help multiple banks re-strategize from a COVID-19 perspective, to better plan from a liquidity and funding perspective. So with that, I hand over to my colleague Ashley, who will look at the credit side of the impact.
Thanks, Satya. As Alok had sort of set the tone, and as the governor has also mentioned, credit risk is one of the primary.
Hello, Ashley.
Yes.
Yeah, just before you start, I would like to make a short announcement. For those who would want to ask questions, questions will be right after the entire presentation is done. But if you want to let us know about your questions, please type your questions into the Q&A box or the text box beneath your screen. So please let us have your questions ahead of time so we can keep to time. Thank you very much. Ashley, you can proceed.
Thanks, John. So as you know, as the context was set earlier, aside of balance sheet and balance sheet related analytics and management, credit risk is one of the critical areas that have emerged as part of, in terms of impacts of COVID, the after effects of which are still ongoing. Anybody familiar with the credit cycle would realize that as the COVID pandemic has played out, pretty much every stage of the credit life cycle has been affected. Right from origination to management to collections to provisioning and the regulatory part of it. New volumes in 2020 across the board globally have significantly reduced on a year-on-year basis, no doubt about it whatsoever. Account management strategies have had to be changed. As the initial stages of the pandemic, banks focused more and more on tighter monitoring, and there was a greater focus on collections that have happened for the bulk of 2020. In terms of models being used, a number of changes have had to be done to the models from a model risk management perspective. Both provisioning models, especially in this IFRS 9 era, where these models are empirical models built on banks' own default experience, etc. These models have had to be built because the conditions in which these models were built earlier on, the conditions that we're currently experiencing, the past year and at least the next couple of quarters, are very different from the conditions in which these models were developed. So, this is broadly the lie of the land as far as credit life cycle is concerned. What we really want to cover in the next 10-15 minutes is try and talk to what changes we've been seeing globally across financial institutions, and talk to some interesting innovations that we are seeing in the market, or at least innovations that started pre-COVID, but they are being precipitated to mitigate the effect of the pandemic in general. In terms of risk origination, or in terms of new volumes coming into the bank in 2020, as I'd mentioned, and as Ghana has also witnessed, volumes have definitely reduced. The risk appetite metrics have changed for several banks. There was a tremendous focus on NPL reduction and on collections in general. So a lot of the effort went into these areas. But now, a lot of the economies believe that they're sort of turning the corner, and that they are going to be limping back in 2021. There are several, because of the sovereign stimulus that's being provided by several sovereigns, there is a desire now to refocus on acquisitions or loan origination. Now, banks are in that phase where they're trying to strike a balance between the collections effort, which is ongoing, to ensure that the NPL levels remain at manageable levels, with the new origination efforts that are coming up. Now, what we are seeing is, and we'll talk to this in a bit as well, that banks that have gone digital, that have had experience in embracing technology, they've been able to react and adapt in a much more fleet-footed manner than the other more traditional brick and mortar kind of business banks. So, in the area of origination itself, we are seeing a lot of inward, inquiries for scanning and spreading tools for the wholesale banking. And there's a lot of inquiries coming in towards us for understanding our automated application scoring engines for, for the consumer business side. But what banks are also realizing is that, as the data and models, as I was mentioning earlier, that they need to also undertake a relook on the data and models being used. So traditionally, especially in the wholesale banking, the lending segment, it was important to look at profitability and track profitability measures over time. But what the crisis has revealed is that profitability is not as important to weather a crisis. More important is liquidity indicators, how strong the business model is, how strong the balance sheet is. So the focus on the KPIs that banks are tracking against their obligors, they've changed over the course of this pandemic. Also, the way banks are managing portfolios, banks in terms of risk origination have had to take a more nuanced views of which sectors to target and which to not, lend to. But again, here they've had to take a very nuanced view in that it's not. Banks are finding that it's not enough to take a view saying that the auto sector, for instance, is risky. They've had to identify subsegments and say that, hey, the auto sales segment may continue to be risky and may not recover in 2021. But something like auto maintenance or auto repairs, that particular sector is probably going to undergo a revival. So, risk segmentation and the way that banks have been looking at industry sectors, they are also undergoing a fairly big change. What slightly more advanced banks are also looking to do is, for something like tourism, for instance, extending the previous example I mentioned, not all tourism sector industries are impacted, right? I mean, there are tourism related industries tourism related industries are typically, extremely driven by the geographical location in place. Now, as the pandemic is being played out, a key KPI as far as the geographical indicator is concerned is the R index, the pandemic or the virus transmission, the number, so as to speak. So, some of the banks that we've been talking to have been trying to take into account the R index and track R index against the geographies and the sectors to which they are lending. So here again, they're taking a slightly more detailed subsegment matrix view of the the potential target market that they want to lend to. But one area where we're seeing a lot of interest in general, especially when it comes to risk origination especially in the consumer lending space, is in the use of alternate data in general, which is what my next slide talks about. I apologize for the slightly small font here. Essentially, this is the case study for a bank, for an NBFC, a new age NBFC in India that we've been working with. The goal really was, this new age NBFC was looking to look at alternate data sources and lend to new to credit customers using these alternate data sources. So it's a fairly well established in geographies that look at such data sources. SMS data is one of the most sought after, alternate pieces of data, so as to speak. So the remit given to us was to identify how to engineer features that we can use to help the bank gain insights for, be it credit scoring, be it income estimation, or customer profiling or segmentation. So the way we went about doing this, finally we had to arrive at a decision engine, but we had to start with using machine language, machine learning, and artificial intelligence related techniques to parse the SMS data, to tag the SMS data into categories. So initially we had to apply filters that would remove the spam versus the non-spam kind of an SMS once access was provided through the app. We then had to identify what we call as L1 categories, identifying what are those parameters that relate to debits versus credits, or financial information that's coming through. So all accounts that all SMSs that relate to savings bank accounts, current accounts, loan repayment type SMSs, all of those are passed again using natural language processing techniques like text embeddings or RNN models are being used here. The next step was to try and get insights from the data. So once we'd identified okay, these are the sources of these SMSs, and we had a master table that mapped to the institutions that were sending these SMSs. We were then able to glean data insights out of this data by using other algorithms like fuzzy matching and pattern recognition based algorithms were used. Feature engineering was then done to try and identify the credit worthiness of the obligor, or come as close to a proxy as possible for credit worthiness of this particular obligor. So overall, once this model was built out, we found that you know uh, model adoption and acceptance, especially in such newer types of digital lending, it happens over time. There is a lot of effort that is spent in improving model performance over time, especially in its ability to perform this kind of risk, the nuanced risk segmentation that is being sought. But what we found also was that better model performance directly translates into improved business metrics. It could be a lower bad rate, so as to speak, at the same approval rate, or on the collection side of the spectrum, improved collection at possibly the same or the lower collection costs. So this was sort of innovation that this particular NBFC was sort of pushed into because of the pandemic playing out the way it played out. Um, Moving on to the next phase, which is related to account management. Again, here what we are seeing is that the objective of account management, at all times, is really to differentiate customers that have a long-term liquidity, that have a short-term liquidity problem, vis-a-vis customers that have a more structural issue. So especially this has come into focus, especially during the pandemic, where it was important to not use a broad brush kind of an assessment across sectors or subsectors, across obligors in that particular subsector. Banks have always been tracking, utilization trends, credit line trends, active versus inactive account trends. What we also, have been seeing is that banks have been actively reducing or reducing the lines for those accounts that have been considered inactive. So the idea here is that in terms of a crisis, customers tend to draw on the inactive accounts during crisis, and to limit potential losses in this case. What we've also seen is that banks have started to track portfolio risk concentrations in a more sophisticated manner and an extremely granular manner in general, as part of account management strategies. Also, banks that have transitioned to other accounting regimes like IFRS 9, for instance, already mandates that a stage assessment vis-a-vis credit risk be assessed as part of its reporting accounting requirements. So stage assessment frameworks, I'm assuming, is something that banks in Ghana have already adopted in place. But at the heart of an account management system, what we are seeing is that banks that have in place have embedded early warning systems in place, which brings me to the next slide. They've been able to manage the portfolios in a in a much more active manner rather than a passive manner. So without getting into too much details of an early warning indicator or an early warning indicator framework in general, just want to talk to a few, mistakes we feel banks do while going about and setting about an early warning framework. Some of the early warning frameworks that we've seen in the market have an extremely long list of early warning indicators. So during the factor shortlisting process, there is always a bias to have the factor long list as comprehensive as possible. But then what actually happens is a lot of these factors that are being tracked, because ultimately the early warning indicators come together in the form of a credit score or an early warning score, basis which you track customers against. A lot of these factors tend to be correlated, and it's important to identify the types of factors that go into an early warning system in general. Broadly, some indicative early warning indicators being mentioned in this particular slide. You have your typical ratings being considered. That's typically the starting point. You have delinquency based indicators being used. You have financial stress based indicators being used, like number of check bounces happening. Also, one thing that banks fail to notice sometimes is that they take a point in time view of early warning indicators in general. The problem with that approach is that sometimes banks with two point in time values of an early warning indicator, customers with similar point in time values of an early warning indicator may have arrived at the early warning indicator score through completely different routes. So it's important to notice what the trend of the particular early warning indicator is, rather than looking at purely a point in time early warning indicator. So which is why simple methods like at least looking at averages, at least looking at moving averages need to be taken into account while drafting your early warning indicator framework. So yeah, I think on the early warning bit, that is the couple of points I wanted to cover. On collections, collections is one area that usually is not in the limelight during the good times, during expansionary times. But 2020 was all collections for all financial institutions across the board, I believe. They have invested, banks have invested and have done a fairly good job of redoubling their efforts when it comes to collections in general. So really the message here is that banks that have done well with vis-a-vis the collection strategy are banks that have been able to take a very strategic view of collections in general. Banks that have invested in analytics to try and identify potential recovery paths that accounts or a portfolio of accounts could take. And to try and track and recalibrate the strategy to identify which category of customers, what is the expected recovery possible, and to go after the high ROI segment, rather than focusing on segments like the segment that is likely to self-cure. So there's no point focusing your collection efforts on segments that are likely to self-cure versus focusing on those customers who have a willingness to pay, whose ability to pay, and this comes from our early warning indicator framework, is currently curtailed because of the pandemic, playing out. So that really was the message on collections here. The use of risk analytics and more digital methods to operationalize the collections efforts. Brings us to provisioning and capital adequacy. So here, this is really a slide that talks to model risk management in general, and talks to my earlier point about how the models that were developed pre-COVID. A lot of banks are finding that those models are not relevant anymore, and it's for a multitude of reasons. Actually, the modeling frameworks, the data that's now coming out of a lot of these models are, for lack of a better word, spurious. For in several geographies, regulators have provided respite in terms of redefining what the definitions of default is. They've been allowed to recognize moratoriums. So if moratoriums are going to be recognized, and then if these customers are not going to be tagged as default, and your unlikely to pay definition also changes to unlikely to pay the rescheduled amounts. So your whole modeling framework that was built, and if you look at the bulk of the modeling frameworks, it's built on a days past due, 90 days past due definition of default framework. That's how the legacy Basel framework was built, and everything else has really been built on top of that. So a lot of those assumptions fall flat, and essentially banks are now struggling to figure out how the data that's coming through 2020 is going to be used to recalibrate the model. And it's actually prudent to sort of take, instead of going ahead and recalibrating all of the models to the latest set of data that's come in, it's prudent to take a slightly more nuanced view of how they want to go about building, recalibrating their models. So there is the through the cycle models that you have in your credit risk capital computation space versus the PIT models that you have for IFRS 9 purposes. Here, it's very important to have conversations with your auditors, with your regulators, to understand what is their view of definitions of default and the expectations around provisioning in a lot of these areas. And as was indicated earlier by the governor also, the central banks have been understanding and have been giving the banks some respite when it comes to a few of these requirements. So, credit risk models, whether to recalibrate immediately or not. So that's one big question. The loss given default, for instance. Now, loss given default, there is a bias for all institutions to actually recalibrate the loss given defaults because of the a tremendous amount of work that they've done on collections the previous year. They anticipate that their loss given default numbers are going to look much better than it was the earlier time around. Again, this may well be true, but again, what banks need to focus on is if these slightly better numbers that they're seeing in terms of recoveries, is this going to continue through the next couple of economic cycles, or was this just a blip because of additional efforts that have been expended in the area of collections? But yes, there's definitely a reason for conversations to be had with auditors and regulators around model recalibration needs. In terms of exposure to default, and again, we go back to our theme pertaining to importance of recognizing the interplay between credit and liquidity risk functions. So if you for anybody in banking would immediately recognize exposure at default, there's a huge a huge component of the exposure at default values in pure logistical or procedural terms come from the ALM function. So the ALM function, or the typically looks at behavioral modeling of the assets and liabilities. In this case, I'm talking assets here, but the inputs typically come from the ALCO or the ALM models that Satya was talking to about. So again, here, organizations that are flexible enough to take into account to be able to capture how exposure at default values change through the pandemic, through different macroeconomic scenarios, are in a much better position to be able to capture such interplay between the various risk type. And the upshot for doing this is that they do not have to build conservative buffers on top of the provisioning numbers that they typically take, where they not be able to capture such nuances. And Satya already spoke about stress testing. Again, very similar points to his. Very important to identify the interlinkages between credit, market, operational risk, and take a integrated view of the overall stress testing framework. Um, Next slide, if you can, Satya. All right, so sort of brings me towards the end of my talk. What are banks really trying to do now? What is it that a typical day for a risk manager look like in a banking organization? Now, during the pandemic, most risk managers were actually at the risk of a burnout because of fairly tremendous demands that were being placed on via reporting requirements. So, the risk managers were dealing with the pandemic on a personal level, working remote, which was a challenge in itself, and then responding to all of these heightened requirements related to management reporting, board reporting, and regulatory reporting. Some respite did come in through various regulators where recognized the cost of compliance when it comes to continuing all of the reporting that they actually needed, and they voted in favor of operational resiliency and to focus more on operational resiliency than compliance for a period of time. So there were some concessions that were provided by regulators. Regulatory deadlines were pushed out in some regions for critical regulations. Even accounting standards were pushed out in some regions. Stress testing submissions, especially in the West, they were West and in the Middle East, to be honest, in Asia, were either delayed or cancelled in several geographies in 2020. But truth is, these were just concessions. All of the requirements are going to come back in 2021. All of the erstwhile regulatory submissions are mandatory, and because of the crisis still unfolding, all of the questions that were being posed during the crisis will continue to be posed for the foreseeable future. So, risk manager gets asked, the risk. It wasn't enough for the risk manager to provide a view on just capital adequacy. He had to be able to provide a view on capital adequacy for a multi-year period, for a multi-period view. He had to provide a view on what the NPL numbers were going to look like, what kind of, in terms of risk origination, what kind of turnaround times would he be comfortable working with to balance out operational resiliency and continuity. He also had to provide answers pertaining to revenue forecast. What is the new revenue forecast coming in under a multitude of stress scenarios? How do interest rate movements translate into changes in capital adequacy, and so on and so forth. So, Satya, if you can bring up the next slide. So really, what banks are looking is to have in place a risk function that has a stylized view very similar to what we have on the slide here. In most balance sheets, while credit is the biggest driver in terms of capital adequacy ratio, especially in traditional lending organization. But as I was saying, he needs to be the credit manager or the risk manager needs to be able to talk to other risk functions also. He needs to be able to recognize the interplay between credit, interest rate, liquidity risk. His domain is not just NPL management, but he's got to be able to build analytical frameworks that take into account dynamic, the balance sheet dynamic, including interest rate and liquidity risk. So some characteristics, if you look at this stylized model, and it's the chief characteristic is that the model takes into account the interplay that exists between the risks. If you look at an event, a credit event, a default event, it definitely flows into liquidity, right? A credit event like default affects not just risk-weighted assets and provisions, but there's an impact on the cash flow profile or the asset liability profile, depending on how big the default was. In traditional stress testing terms, if your top customer defaults, there's going to be an impact. It's important to recognize recognize these interplay and be able to capture this in your integrated risk management framework. What you will also notice is that the risk return metrics, and this is of course not an exhaustive list. The risk return metrics is focused not just on capital adequacy ratio, it's focused on capital adequacy ratio, RWA numbers, the LCR, NSFR, profitability, the leverage ratio. So both regulatory as well as non-regulatory view being taken into account, and a view that cuts across, that is organization wide and cuts across several risk types. Also, a couple of other characteristic features of this. It's extremely, as Alok was mentioning earlier, the philosophy has to be extremely forward looking. Gone are the days of looking at current balance sheet positions and assessing what the metrics are going to look like, say a default, if a default happens. It needs to be forward looking. It needs to take into account both idiosyncratic as well as macroeconomic or other systemic factors. It needs to be dynamic, not static at all. And as I was mentioning, a multi-year view, they should be flexible. The analytical framework needs to be flexible enough to be able to determine, the time horizon over which such analysis can be done, and to be able to project out both balance sheet and P&L over various time horizons. And really what we're seeing is that banks that have sort of focused on BCBS 239 type programs that relate to risk data aggregation and reporting, they are in extremely good stead when it comes to being able to provide such views. They've been able to, some banks have been nudged, with some banks with latent capability have been nudged during the pandemic to develop such analytical frameworks on the back of strong risk data aggregation and reporting frameworks that they've already built over time. And this enables the risk manager to be able to provide answers, and in an ad hoc manner. The demands that are being placed over risk manager is, especially with respect to responsiveness, he isn't provided days or weeks to come back with results. Senior management and regulators expect to see results not even overnight. They want to see the results on the fly. So that's the level of preparedness that is an expectation on the risk manager in general. And from our side, the message really is that institutions that are willing to take an integrated view of risk, that are willing to that are willing to merge traditional methodologies with the new and coming and the alternate methodologies and alternate data, will be in a much better place to adapt to these rather uncertain times, and will be in a much better place to navigate this crisis. Thank you. That was sort of the end of my presentation.
Okay, thank you very much, Ashley, Satya, and Alok, for those fantastic presentations. We now turn to an open forum for questions and answers and discussions. But before then, there are questions that have already come through. So all three of you must be on standby to answer these questions for the benefit of our audience. The first one, which came from an anonymous participant, it says, does risk impact negatively on tech innovations deployment in banking during these uncertain times? How can we innovate at the same time deal with these risks in uncertain times? So that is one. We also had a question from Samuel Dakon. Do you see lending with alternate data becoming more feasible in corporate banking as against consumer or retail banking in the short to medium term? There is another question. The pandemic could have negative impact on concentration risk, given that some key sectors have become virtually inactive, skewing concentration to least impacted sectors. Would you advise banks to adjust the internal concentration parameters to accommodate the new normal? And those are the first three that I would like you to take, and there are others that I will take when you have answered these other questions.
I think I'll, take the one related to use of AI ML in the commercial lending space. This is an area that's sort of been pushing the boundaries, right, when it comes to usage in the banking industry in general. So use of AI ML model, especially in regulatory compliance space, has typically been frowned upon, especially because of difficulties in explaining the model, difficulty in explaining the parameters that have gone into the model, and so on and so forth. So right now we are at a time where these models can be explained to an extent. There is explainability that's been brought into the AI/ML piece. We're seeing more and more acceptance of these models when it comes to using for business use cases. But that being said, so in the commercial lending space, an immediate use case that that a lot of banks are looking at is in an item that takes up a lot of time and effort in terms of the credit workflow process, which is scanning and spreading of financials. So when it comes to scanning and spreading of financials, the artificial intelligence and machine learning fraternity has made a lot of strides when it comes to such natural language processing. So the strides that we've been able to make as an organization also in terms of accuracy when it comes to scanning these annual reports and then spreading them out. So there are multifaceted challenges here in scanning. In scanning, one of the challenges is a lot of the annual reports, the balance sheet and the P&L, especially for the SME sector, they tend to be scanned copies that are made available to the RM. In the earlier, 5 years back, the OCR technology was not good enough to be able to scan such skewed or noisy documents in AML parlance. But now with advanced machine learning algorithms and AI algorithms in place, we are seeing extremely good accuracy rates when it comes to parsing both text and noisy PDFs, if I may put so. Also, the next challenge is because it's not enough to just parse the P&L and balance sheet. It's also important to get it into formats that organizations use. So all organizations have a very specific templates that they use for their credit decisioning purpose. So again, here, there is a need to be able to sort of standardize these balance sheet and P&Ls in formats that the bank's credit systems can understand, or the credit functions can understand. So again, artificial intelligence, and I made reference to some fuzzy matching algorithms are currently being used. Again, very promising results being shown by our clients who are using such solutions. So that's definitely an area where we think more and more adoption is going to take place, especially because a lot of banks are trying to go digital. So why not, why stop at just consumer lending? Look at the corporate lending side of things too.
Yeah. So thanks, Ashley. John, I'll take the first question. Does risk impact negatively on tech innovations deployment in banking during uncertain times? And I tend to disagree because it's always been said in the risk management world that you have to visualize risk as a brake pedal and innovation as an acceleration pedal. So a brake pedal in your car actually helps you accelerate. You can run at a faster speed and go to the higher speeds because you have a better control through brake pedal on your car. So I think it goes if you have thought about innovation in a risk risk way, then you can accelerate your innovation, and at the same time making sure that you are not exposing the organization to newer risks, or increasing the risks of existing profiles. So a well thought of risk management, in my view, will significantly help you accelerate the innovation. And that's what, if you see globally, has happened. Most innovative companies are the companies which are best at managing risks. So it goes hand in hand. I think the question which relates to the second question on the
Concentration.
yeah, it is more intended for central bank, I would say.
Okay. Yes, George Mensa wants to know, how do banks and regulators leverage technologies around to minimize the risks associated with doing business post-COVID-19 era? There's a question here which I believe is for a regulator, but I'm not sure this is the forum for it, but I'll just throw it out there. Should banks expect an expansion? It's from Annie Abora. Should banks expect an extension of the regulatory reliefs to help minimize the impact of COVID-19 second wave on NPLs, provisioning unexpected credit losses? And that is not to our facilitators, but we will take it maybe as a backpack. Arjun Sundar also want to know, how do we decide on inclusion of 90-day past due standard cases in default data points? Borrowers are standard by virtue of moratorium. Not too clear about the question, but that is the question from Arjun Sundar. And we have Timothy Mugodi, who also says, how are banks across the world dealing with the increased expected loss right now, since they are still in the process of upgrading models? An updated model probably requires data over a period to make them accurate. Are they applying overlays? That is the question from Timothy Mugodi. And Kwame Ahiabenu also questions, he says his question goes directly to the governor, Dr. Addison. How is the central bank supporting RegTech in its compliance and risk management functions? Tech in its compliance and risk management functions. And Kenneth Amponsa also asks, considering an active cash flow approach to lending decisions, how useful is open banking an alternative or option to be adopted?
Yeah, actually, I'll take the one with the data and ECL.
Right. I'll take the two very specific questions. The one from Arjun related to whether the moratoriums how are moratoriums being accounted for in days past due. So actually in some jurisdictions there's very specific guidance. There's a recommendation from Basel that moratoriums be taken into account. So what that, in essence, the interpretation has been that if there is a moratorium and accounts have gone past 90 days past due, then they are not to be treated as default. And I'd imagine, if in reality in credit monitoring you do not treat them as default, then for your ECL model purposes also you do not treat them as default. But again, I am aware there are multiple views around this, and that the alternate view, of course, is that this is a critical downturn data point that you would lose out when it comes to modeling your default rates. But both points of view. But that being said, some regulators have gone ahead to the extent of saying that DPD counters can actually be stopped for several customers, not physically stopped. So the reporting, the automated reporting that they used to do for the central bank purposes, they pretty much asked that they not be reported, and those days past due do not be counted for a period for a period in 2020. So I think my view is that on an overall basis, most regulators and jurisdictions are leaning towards allowing this extent of leeway. But again, this is a conversation, as I said, that needs to be had with the auditors and individual jurisdictions regulators. The other question was with respect to ECL models and what are banks doing with respect to ECL models as the pandemic is playing out, as there's still no clarity with respect to macroeconomic outlook, which is a key ingredient of the ECL model in general. So banks, yes and no. Some banks have gone ahead and updated their models. There are banks that developed the models in 2017 and have been continuing to use these models for whatever reason. I mean, various geographies, various jurisdictions, various levels of sophistication. So those banks, I mean, 27 models developed in 2017 or 2018, they're too dated to be used for purposes of IFRS 9. So they've in fact used, several banks that I know have in fact used 2020 to go ahead and redevelop the models. But again, question is, what do they do with the 2020 default data? So again, various treatments being applied here, some judgmental overlays being used here in terms of the default experience that's being used to inform the ECL models. But yeah, there's a fair amount of management judgment. There's a lot of conversations that happen with auditors, with the regulators, and our opinion generally is that as long as there is full transparency in the decision making process, the auditors and the regulators are generally comfortable to provide such leeway when it comes to management overlays. And also, what I've consistently seen is that in most banks, because of the ensuing situation, um, the overlays have been, they've been extremely generous when it comes to the overlay number being used vis-a-vis the ECL. So what I mean to say is they've gone overly conservative in general when it comes to provisioning. At least the couple of the number of clients that we've been interacting with. So these were the two questions. If there's anything else.
Yeah. I think you've taken all three. Two of them were similar questions, so I'm not sure we'll need a separate answer for that. Mr. Tioai wants to know, in your opinion, what is the future of risk management in banking most likely to be like? And what will be the ultimate risk framework that adequately supports the future of banking model? There's this question that has been, perhaps may have been answered, but just in case there are other variations to the answer, it was asked by Kofi Ejaku-Kwatin of Ecobank Ghana. How can artificial intelligence and machine learning help in corporate or commercial lending in ways that helps to better manage risks? What are the challenges that banks will face in using AI and ML in managing risk? Thank you. I should take it that those are the last batch of questions. And after that, we will give the closing remarks and bring the curtain to a close. Thank you.
Okay, so thanks, John. Two things. One is that I'll take the artificial intelligence question first, which is so, artificial intelligence no longer is seen as a separate box, and banks are now blending it with the conventional intelligence or human intelligence. So the augmented intelligence is what is now becoming the norm. So which actually blends the human intelligence or conventional modeling framework and augments that using the supplementary artificial intelligence framework. So, if you look at in that perspective, then it becomes a very natural way forward. So you look for ways to augment your ability to better identify, estimate, and predict the risk. And that is the direction. And the direction, though it started, as rightly pointed out, largely from the retail and consumer end of the banking, but very rapidly expanding in the commercial and corporate bank, especially the areas which relate to using the lot of alternative data source and areas which relates to massively deploying the text analytics, or which is also the natural language processing capability, where you can read through the document, whether it's financial statement, bank statement, third-party reports, credit reports, or use your internal documents such as your loan covenant agreements and comments, or internal RMs, conversations and mails. So that's how they're augmenting and capturing the information ahead of competition, and that is where the adoption is happening now. What is the role of the future of risk management in general going forward, and the risk management future is going to be where it becomes more and more invisible. And when I say invisible, means that it is actually embedded within the business and processes. So traditionally the risk function has been seen and been focusing in making them some more and more visible. So it's been seen as a silo, and in many organizations it's seen as a an organization which looks obviously in bringing the risk down, but at the same time do not lay equal emphasis on the business aspect. So my view is that the future for risk management is simple: embed yourself, become invisible, and it becomes part of business decision, innovation, or transformation, and that is the future. So if the risk management focuses on embedding themselves more and more with various functions while maintaining the independence and objective, that is the future what we see globally happening. And so majority of the banks now have two parts of the risk function, where they say independent risk function, which is at corporate or group level, which is more visible and differentiated, and in business risk function, which sits within the business or tech or ops, which works very close to the first line, and which is more invisible part. So this is the future model which is emerging globally, where you have independent risk and in business risk or in operation risk, and both work in a synchronized manner. So that's where the risk management is heading globally.
Okay, thank you very much, Alok, Ashley, and Satya, for those fantastic deliveries. We really appreciate your time and the message that you've sent to all of us, and the answers you've also given to our questions. There are some of the questions that we found them to be a question not for this platform, but we've noted all of them down and the names of the people who asked them. We have your email addresses, so we'll try and get to the right people to answer those questions and specifically direct the answers to your mailboxes. Thank you very much. At this point, we invite the Second Deputy Governor of Bank of Ghana, Mrs. Elsie Ado-Awadzi, to give us the closing remarks. Madam, over to you.
Thank you, Mr. Wa. I hope you can all hear me.
Yes, please.
Okay, excellent. Executives of the Ghana Association of Bankers, the chairpersons, CEOs, and staff of various banks, executives from Aptiva, invited guests, ladies and gentlemen, I'm sure you'd all agree with me that we've had a very successful webinar. So at peak, I could count about over 210 participants on this webinar. And judging from the number of questions that we have had on very pertinent issues, I'm sure that you're in no doubt at all about how very rich this webinar has been. We were honored to have had a keynote from Governor Addison to set the tone, and what has ensued in terms of the technical presentations and the Q&A session has been very animated.
Permit me, ladies and gentlemen, to reiterate a few key truths that we have heard from all of the speeches and presentations so far. I'm going to put these down to about 3 key highlights that will form the basis of my closing remarks. And then I'll provide a few thoughts as I wind up. Banking is inherently risky. That is not new. Banks are themselves risk machines. And the reason why they're so highly regulated all around the world. What has happened in the midst of this pandemic is that these risks that are attendant to normal business banking have been exacerbated. You will call it even to unprecedented levels, right? Many of us alive today have never seen anything close to the pandemic. And this is an occurrence that comes in once in 100 years or something like that. So this has been very drastic, very, very severe. And as a result, we all are concerned that the risks that you've heard about, some of which you've heard about today, that banks are facing today could severely impact them, not only from a business sustainability standpoint, but also from a financial and an operational resilience standpoint, if these risks are not carefully managed. As other speakers have said, some of these risks include balance sheet risks, especially from asset impairments, and the attendant higher levels of provisioning required, and how that impacts on profitability as a whole. And then you have the heightened operational risks as a result of the changing business models in response to the pandemic. And then you have the cyber risks, as well as which is part of the operational risk anyway. And then you have your AML, CFT risks, which are also becoming very pronounced, with correspondent banks even de-risking their respondent banks. So all of these are happening at the same time to banks, not new, but at a whole different level. And then you want to add to it, as a result of what the pandemic is doing to the real sector, you want to add to it risks that are not talked about as much, but equally important. And these are risks to financial exclusion. Many small business owners, many informal sector workers, many people who held jobs, who have lost their jobs, have lost access sometimes to their savings accounts or are not in good standing with their creditors. And this has a large, huge implication for us as we go forward and as we try to rebuild our economy in a sustainable way. And then add to it the looming climate risks that all around the world banks are beginning to face. And let's not underrate the importance of these risks. We live in West Africa. The Sahel region is beginning to see that this risk is not as minimal as they have thought. And this is closer to us than we had imagined. So these are all part of the plethora of risks that banks are having to deal with as they try to stay alive in the pandemic. The second key point I want to make is that managing these risks is also very, very complicated, because there's so many unknowns and unknown unknowns in the midst of the pandemic. How long is the pandemic going to last for? How long must banks provide moratoria for? How long are customers of banks going to get back on their feet? When can banks return to normal, in the way they operate? And this makes risk management today very difficult, because you don't see the end point and you don't know for how long you need to sort of deal with these exacerbated risks. That said, this comes to my third point. Managing these risks is no less important. It's difficult to do, it's complex, and in many parts, some of your traditional risk management tools may not be able to help, but this actually invites us all to think of more innovative ways of managing these risks that are so fiercely affecting banking today and the sustainability of banks. On the part of Bank of Ghana as regulator, we expect the industry to be proactive and innovative in the way they approach these risks and in the way they effectively manage them. Let me remind you all that we do have a fairly clear regulatory framework in terms of how we expect banks to manage risks every day, but in particular also in the midst of the pandemic. The provisions of the Banks and Specialized Deposit Institutions Act 930, are very clear on what is expected of banks in terms of risk management. The Corporate Governance Directive is also very clear in terms of how banks are required to organize themselves around risk management. In particular, our framework designates risk management as a key governance function, and we place this at the doorstep of the Board of Directors. So we expect the board to set a tone, and we expect that the internal culture, business culture of the entire bank reflects the seriousness that the bank attaches to risk management. And so we expect the board to put in place the appropriate structures, the policies, the strategies, and the processes, as well as the communications and reporting arrangements in-house to be able to effectively get on top of these risks. Let me add that as part of our Basel II and III rollout process, we are also working on a specific risk management directive. In due course, we will be able to expose this to the industry, and we'll be very happy to hear what the industry says. So some of the risk management tools that you heard from the Aptiva presentation, including how you manage your liquidity risks through the LCR ratios, the NSFR, and all of that stuff, which we don't have today, but which are going to come on board very soon in the context of this risk management directive we're preparing in compliance with Basel II and III, which we're committed to rolling out fully. Let me say that we also, as regulators, have a role to play. We know that, and we remain vigilant in monitoring the risks that you face as an industry. I'd like to assure you that you're not alone, and we also are facing these risks or some of these risks, or in any event, it is important that we all support the banking industry so that you rise above these storms. We continue, as regulators, we continue to explore ways in which we can make our mandate as regulators and supervisors even more effective in these times. So in addition to everything we've done, including providing guidance on how you work on your expected loss computations under IFRS 9, including how you sort of provision for loans and all of that stuff. We also continue to enhance our offsite supervisory tools, because as you know, as a result of the pandemic, we're not able to come on site. And so this has involved a lot more reporting by you to the Banking Supervision Department, but this is necessary because we need to understand a little bit more how these risks are impacting on your businesses. We continue to carry out our periodic stress test as well, so that we're able to assess the level of capital buffers in the industry that would, and whether these will be sufficient in the worst case scenarios that we project. We also are working very hard to roll out a new supervisory surveillance software, which you know about, the ORAS. This is an artificial intelligence-based data capture, data mining, as well as analytics platform that would help us better assess, better identify early warning signs and do something about it. I heard a question about whether the regulator is employing RegTech or SupTech in its work. Yes, this is an example of what we call SupTech or RegTech, very related. And this is enabling us to do our work more effectively, particularly in the times that we live in. Don't forget also that we have come out with a template for reporting, for banks reporting on ESG related risks, which are the environmental and the social risks, which I'm sure the Banking Supervision Department has had conversations with the banking sector about in recent times. And we expect that this would enable you to report on climate and related risks going forward. So let me just wind up by saying that on your part, we expect that the capital buffers that you have worked so hard with your shareholders to provide over the last few years, thanks to the banking sector reforms, you would preserve these buffers. It is important that even as losses hit your balance sheet, you continually have enough buffers to mitigate these losses. And we do hope also that with the risk management tools available to you, you will continue to promote your operational resilience as well as your business resilience. And keep in mind the importance of keeping depositors' funds safe and ensuring that the risks that you face as individual banks, as an industry, do not get out of hand, so that our financial stability objectives are at risk. So I would like to, at this point, just remind you that the tools that you have just obtained from this webinar, from the Aptiva presentations, hopefully have given you a toolkit, a very dynamic toolkit that hopefully you would use to weather the storms that we all face. And we as regulators will be right there with you as we continue to engage with you and as we continue to find new ways in which we can keep the banking sector relevant and enabling of the growth that we want to see in our economy. Let me conclude by thanking the Association of Bankers and actually commending you for your foresight and initiative and leadership in putting this webinar together. Let me thank the Aptiva team for your great technical insights. And let me thank all the participants who have been so engaged throughout this webinar. Let's continue to build our industry. I do have a sense that from the questions that remain unanswered, you may have to do a repeat of this or a follow-up of this pretty soon, because the questions remain relevant. And I believe that a lot more discussions and consultation and learning must take place. So may God help all of us, keep us safe, keep our banking industry safe, resilient, and may Ghana be the better for it. Thank you very much.
Thank you very much, Madam, for your insightful thoughts and closing remarks. Really appreciate it. At this point, on behalf of Ghana Association of Bankers, I would like to first and foremost thank God for bringing this program to a successful end, and also to lay a hand of friendship and thanks to our regulator, in particular, the Governor of Bank of Ghana, Dr. Ernest Addison, for agreeing to grace this occasion and to deliver the keynote address. We also thank Madam Elsie Awadzi, our own regulator, Second Deputy Governor of Bank of Ghana, for staying throughout the presentation and for your thoughtful points at the tail end of it, which we've noted. And as you said, we've already been receiving emails and text messages of when the next webinar is going to be. So as an industry, we'll continuously be looking into our fold to understand exactly what emerging trends affect the industry and our banking population, and we'll come out with innovative programs that would engage our participants. And also to Aptiva, you've delivered as promised. Hopefully we'll have a lot more opportunities to collaborate in future. And to Alok, to Pratik, and to Ashley for your wonderful presentations. There's a lot of demand for the slides, and I know you have your own house rules, but offline we'll have to engage to see how best we will get our participants to better benefit from the delivery that we've had today. And also to our President, Mrs. Mansanete, the Vice President, Mr. Dan Saki, and all the Executive Council members and Managing Directors of banks who have stayed the course and been on this webinar. We thank you for having the time to participate and to make this very successful. And to all participants, we know you all have jobs to do, you have things to do, and you thought it wise to stay with us. At its peak, we had in excess of 240 participants on this webinar, which is something that is to be proud of. And we thank you all for making the time to be part of this. Hopefully, very soon you'll hear from the Ghana Association of Bankers again. Bye-bye.
Thank you so much.
Thank you so much, everyone.
And just on a update on slides, we will be communicating with all the attendees and the registrants by tomorrow morning and sharing further information on the slide deck that we can. Thank you so much.
Thank you. Bye.